from the News Channel 5 Network. This is OpenLine.
Good evening, everyone, and welcome to OpenLine. I'm Carrie Sharp. Thank you for joining us tonight. Tonight's topic, we're talking about the stock market. And if you are shaking in your boots over what is happening right now, hopefully the next hour will calm you down just a little bit. I've got a great guest with me to walk us through all of these tough questions. Dale Smothers is here, founder and president of RDS Wealth Management. Dale, thank you for being with us.
Yes, ma'am.
This is a volatile time. It is a unprecedented time. I think we've used that word time and time and time again. We're talking about inflation and interest rates hikes. It could happen again this week. Before we get to all that, I want to remind everybody this is OpenLine. Call in with your questions. Now is the time to ask them. But I want to hear about you first. Tell us about how you got into wealth management, what's your passion, and who you are.
Oh yeah, so believe it or not, I actually got into wealth management through a course of starting in the insurance agency with the idea of protecting people's loss or their risk.
Yeah.
So it was mostly a life insurance salesman is what I was at the very beginning. My father got me into that. My father's probably the reason that I am who I am today. And to be honest with you, I'm now father of two amazing kids, Matthew and Andrew. They are my passion. They're the reason that I even wake up in the morning, for sure.
I understand that. I have two little boys of my own.
Yeah, for sure. And so going from the life insurance side, I began to see the sales idea of life insurance. And while life insurance is an extremely important part of the plan, it's not at all the holistic part of the plan. And so what I did is I took that sales knowledge and positioned it to a advice side of the aisle and became a financial advisor about 12 years ago. Got into this industry of giving advice. And I remember the very first time that I had a client walk away, never bought a thing. And so again, it was all sales back in the insurance days and knocking on doors and making sure that you were able to walk away with a commission. That was never my passion. It just didn't drive me. But the first time I sit down with a client in my office at my table and they walked away not buying anything and they said, "What do we owe you for this advice?" Changed my career.
Yeah.
So being able to direct people, teach people, help people understand their finances. I always say if it doesn't make sense, it won't make dollars.
Yeah.
And so we do our absolute best to coach the individual that we're talking to on how they can better their retirement plan, how they can better their financial future. You know, the passion that I have for this industry, it's been cultivated over the last 12 years. And because of that, we've seen a lot of highs and lows in those 12 years.
We sure have.
You know, I was kind of blessed with the whole bull market that we've seen in the last little bit, which is a market that's going up. But understanding that there is protection that needs to be boiled into a financial plan, I attribute that to probably my insurance days. So it wasn't all bad. You know, the sales thing is behind us, but the understanding that people need to make sure they're safeguarding risk, especially in times like this, it all kind of comes full circle.
Yeah, and that's where I started. Times like this, I mean, we are going through extreme volatility. People are saying, how am I ever going to retire? I can hardly make it through this month on what I'm making, right? How can I put extra away? But it's so very important to plan for the future. And for those who are putting money away, we're getting those statements in the mail or getting an email saying it's time to check your statement. I'm not opening them up right now. It terrifies me.
And that may actually be a wise thing to do, is to just put it aside, because we know the market's down. One of the hardest things we have to overcome is this behavioral finance of selling when it's low. Everybody wants to buy when it's high, and it's the total opposite of what we should be doing.
Right.
But there comes a point in time where you do have to open up those statements, and that's when you're about ready to retire. You know, so far into the future is tomorrow for a lot of people, and we've been putting money back, I like to say you squirrel this money back, and then one day you're going to have to be able to go back and get that money. If that's you today, you're probably a little bit fearful.
Oh, sure.
And what our goal is, every single time we sit down with a retiree, and we're talking about somebody that we would consider in the retirement red zone. So football's on tonight, right? Titan, let's go Titans. When you get to that 20-yard line and you're about to punch it in, they call that the red zone. And I see so many people who come into the red zone of retirement and they're still calling plays as if they're on the 50-yard line. They're passing for the risky play, the Hail Mary play. Is a 50-yard completion a good thing? I mean, if they caught the ball 50 yards completion, you're on the 10-yard line, you're out of bounds. that play doesn't do you any good. So taking too much risk as you get closer to the end zone in retirement is a dangerous thing. And so for those who have to open up their statement, figuring out how to make this play change, calling the right plays. How do we do that? That's ultimately what we help a client do.
I mentioned we're seeing a lot of volatility. Why is the stock market so volatile? What is it? What is it going off of?
So much. So the year started with a ideological war on energy. The war on energy really spilled over into an actual war in Ukraine, which we've all heard about. That war created a ton of volatility. Couple that with the supply shortages, the bottleneck that we saw on the West Coast, less supply, more demand, inflation. And then because of inflation, now we have the Fed that is hiking these interest rates, and ultimately what led us up over the last 10 years or so has been stocks that are what we would consider growth stocks. So your technology sector is a big one. They're not paying a dividend. They're actually borrowing money to do what they're doing. And when they have such a debt obligation on money that is now more expensive each and every day, as interest rates go up, they have to pay more. That means their bottom line gets a little smaller. And when their bottom line gets a little smaller, investors want to sell those stocks. And so it becomes this small downtick in the market, which then spirals out of control because of a lot of trading tactics that we have where we're maybe some sort of margin calls, which gets into the weeds on what's going on, and computer trading, and everything starts to become this self-fulfilling prophecy. And then you've got the people who do open up their statements. They never pay attention to it until they get their statement, and they're down 10%. I want to sell. And that just creates this downward tick. And so eventually things do calm down. We're in a situation right now that we really haven't probably seen since the 70s, where we've got inflation at all-time highs. We're on the verge of a recession. It's something called stagflation. And this idea of stagflation, without getting into the weeds, means that we have inflation at all-time highs, and they continue to go up, and we have growth potentially trending down. And so this idea of stagflation creates a conundrum for the Fed. That's why we got Fed Chair Powell right now talking about a soft landing. We just got to make a soft landing. And my fear is that the pendulum will swing, and we could potentially start to see negative inflation, which is not terribly good either. So it's just a great deal of question in the market. And with uncertainty comes volatility.
Right.
And that's what we're seeing. We're seeing this amazing amount of volatility, highs and lows. And volatility is really only talked about whenever it's trending down, right? When it's trending down. Then we can have days of highs and lows as long as the overall trend line is going up. We don't care about volatility.
Right.
But in times like this, volatility becomes a keyword that everyone likes to use.
On Wednesday, the Fed will meet again. They've already raised interest rates twice this year, I believe. And they're basically saying they're going to do it again. I mean, everyone expects that. What's going to happen on Wednesday, Thursday to the stock market?
Yeah, so 75 points. There's going to come this point of time where we're going to see the stock market start to already bake in the rate hikes that are coming. So potentially last Thursday, Friday could have already been in preparation for the rate hikes. To say that I had this crystal ball, unfortunately, I left it back home.
What?
Yeah, we just don't have that here. But I'll tell you, I know that whatever it is with retirement planning, when it comes to retirement planning, we have to get away from the what if or what happens next and be more in line with what are we going to do when it happens? Because we know it's going to happen.
Yeah.
We know that the market's going to go up. We know the market's going to go down. And ultimately, how do we then position our income, which is the key word in retirement? Income. Retirement wouldn't be that risky, wouldn't be that fearful if we still had a stream of income coming in.
Yeah.
That's the biggest thing about retirement planning, is that we walk away from public work. We no longer have income coming in. How do we make these assets, everything that we've squirreled away, how do we make them become income? And if we can do that with certainty, it takes away fear.
Is there a good formula of saying this is how much I'm going to need in retirement?
It's a really good question. So if you're on this red zone, you can almost start to say, okay, if we're at the 1 yard line, we're retiring next month or next year, you almost have already baked in your equation, right? You've already said, this is how much money I have. I don't have a great deal of human capital left, because there comes a time where, when we're young, we have human capital. We don't have much actual capital, but it begins to counterbalance, where human capital is gone, but we've stored away a lot, if we've been wise, a lot of actual capital. And so once we have that equation already set for us, we can kind of work backwards and say, we know that we can take about 4% per year out of our total account. So if you have $1 million sitting in your account, you look at $40,000 per year. Now that comes to us from some research done back in the early to mid 90s, 1994 I believe was the year. William Beacon, a gentleman named William Beacon, did this research where he took 50 plus years of market performance, and he looked at that 50 plus years, and it had some major highs and some major lows, and he came up with a 4% rule, which is commonly known as the 4% rule today. That 4% rule tells us that if we can take, it's incredible what he did. When I say he did some research, I'm definitely underselling what he did. He probably should have won a Nobel Prize for this. It revolutionized what retirement planning became.
Wow.
And he says if we can take a 60-40 portfolio, 60% stocks, 60% equity, 40% fixed income, and I say it like that because it makes a difference now. Stocks today may not be the true equity we need to hold. Bonds today may not be the actual fixed income we need to hold. But if we can take 60% equity, 40% fixed income, put it into a well-diversified plan, and then take 4% per year, theoretically, according to the research, we have 30 years of retirement.
Wow.
30 years of retirement. Now, here's where that research maybe falls apart a little bit in a today's age retiree. Interest rates are on the rise. We haven't seen this low of interest rates. Now, granted, if we were talking 6 months ago, we hadn't seen lows like that in the interest rates, right? But with rising interest rates, the fixed equity position won't perform as well. And that's getting into the weeds. What we've got to realize is now the economists of today are saying that 4% rule is 2.7%. 2.7, 2.8%. What does that mean? If you got $1 million, you can take $27,000 a year off of it. So are you a millionaire? No.
Right.
You're a $27,000 an heir. Can I say that?
Yeah.
$27,000 per year. That's an eye-opening number whenever clients sit down with us. So how are we able to take that money from 2.7 back to 4, maybe even as high as 4.5? It's how we build those portfolios.
Very interesting.
Your question, is there a balance? I think there is. So that balanced portfolio of 60-40 can still hold true as long as we have our 60% in stocks that are well diversified, paying dividends, a little bit of growth inside of there, and be happy to talk to someone if they do call in about specifics on how that looks. And then the fixed income side used to be bonds. So we used to hear 60% stocks, 40% bonds. Bonds in today's environment actually could show capital losses. So what we expect to be safe money could actually start to lose money. And we've no doubt seen some of those people that are supposed to open up their statements right now losing money even in their bond position because as interest rate rise, bonds lose value.
Very interesting. Okay, I can tell you're passionate about this. We're going to take a quick break. More when we come back. Stay with us.